Yes, please.
Okay.
All of them? What? Okay. I don't think necessary. I think it's, I know you probably need some help. So anybody need help for the first question? The first one? Which chapter? Chapter 6. Chapter 6, okay.
Let's see. It's, I believe. Okay, so for me, I think it's kind of important to, I guess, run through some.
This is your homework.
Yeah, so run through some terms because I think it helps when you understand what you're looking for. It kind of helps understand the homework a little bit better. So some of the things you're going to be looking for is expected return, and that is the profit or loss of an investor anticipates on an investment that has a known or anticipated rate of return. It is a tool to determine whether an investment has a positive or negative average outcome. And I'm using Excel, so I don't know if you want me to use the calculator. I don't know how to use the calculator on the JU Finance. I'm using mostly Excel, so I can use it if you want, but I might need some help. But how to find it in Excel, it's as easy as simple as sum product, and then you put the probability in the first part, and then return in the second part in Excel. And then next is holding period return, and
How do you
that's
calculate the standard deviation then, if it's asking you to calculate standard deviation?
I guess we could just do equal stand div, like. Let's see if it lets me,
But for
Standard.
expected return, you can.
I can?
You can. The equation, you have to use the equation and calculate it by hand. Like this question, how can you, it's not asking for standard deviation, but if
It's asking for the expected return.
Yeah, but how to get the standard deviation, then you have to do that by hand.
Okay.
But for this, if it's asking for standard deviation, you can use the calculator. So
Oh, okay.
It has the equation, it has the answer.
Oh, I know what you mean, okay.
Yeah.
Okay, where was I? Okay, holding period return. So that is the total return from holding an asset or portfolio of assets over a period of time. Generally expressed as a percentage, it is particularly useful for comparing returns between investments held for different periods of time. And we'll see that in the homework. And to find that, you have to find the change in prices. You're going to do the purchasing price subtract the selling price. And to find your holding period return, you're going to do the change in price plus dividends divided by the purchase price. Okay, and beta, I know we talked a little bit about beta last class. Beta is the investment indicates whether the investment is more or less volatile to the market as a whole. It is a measure of the risks arising from exposure to general market movements as opposed to idiosyncratic or very specific factors. Anything above a beta, above 1, is considered more risky. Anything below 1 is considered less risky. And so to find that, you need to find your weighted amount invested, which is going to be your invested amount divided by your total amount invested. And then to find your weighted beta is going to be your beta times the weighted amount invested. And we have risk-free rate, and this is the theoretical rate of return of an investment with zero risk. And since there is no such thing as a risk-free investment, it is used as a starting point to calculate the cost of equity or capital. For example, a bank might start out using a risk-free rate as a starting point and then might add on other risks, just more of like a reference. All right, market risk premium is the difference between what an investor expects to make as a return on equity on a portfolio and the risk-free rate of return. It is the additional return an investor will receive from holding a risky market portfolio instead of a risk-free asset. And I kind of have like a diagram here to kind of explain it a bit. See, as the beta of the market, as it gets more risky, your return ends up getting higher. And then your market risk premium is going to be the difference between these two. But also keep in mind that if something happens in the market that makes it go down, the more risk you have, the more chance you have of you going in, your investment going negative as well. And then to find that, market risk premium is your market return minus your risk-free rate. Expected rate of return refers to the excess of return that investing in a stock market provides over a risk-free rate. This excess return compensates investors for taking on the relatively higher risk of equity investing. As a rule, high-risk investments are compensated with higher premiums. And to find that is risk-free rate plus beta times market risk premium. So for number one, a stock has a following return of various states in the economy, and find out stock A's return. So expected return.
8.2%. Anybody got a different answer? No? Yeah. Well, there are two ways to do that. Tristan is using Excel. Yeah.
I just used some product.
You have to create a table first.
Yeah.
Create two columns. One is probability. It has to add up to 1. And then the return under each circumstance is given as another column. So then you use some product.
And that's going to give you your expected return.
But to do the standard deviation, there's no simple way in Excel. You have to use the equation. Yeah. Also, can you show us like if it's a calculator?
Yeah, I don't know how to use that one that well, but I'll try to figure it out. Let's see.
Yeah. Go to
this one.
Yeah. So probability. So just put down probability and put down the return.
Let's see.
10, 20, 40, 20, 10.
So stick.
No percentage.
No percentage. Let me move this over so I can see it a little bit better. So 10, 20, 10. That's a probability. Oops. And then returns.
Yeah, so you use this calculator, you don't add percentage. And this calculator allows you to have 2 stocks, but we just need 1.
Okay.
Yeah, so 8.2%, but you see the standard deviation 16.98%. Yeah, if you scroll down, you see the equation. The standard deviation equation, if you use Excel, you manually calculate standard deviation based on this equation.
Okay.
So this it's convenient. If you have another stock, and it will calculate the correlation for you. The equations is also down below.
Okay, right here.
Okay, so do you have trouble to use the calculator?
Okay.
Okay, and use some product in Excel.
Yeah, for if you're using Excel, some product. Okay.
The second one,
So-
you have to do one by one. Do you guys got the second one? 15%, that's correct.
Do you want me to run through it, or you just want me to skip it?
I don't think we need to do one by one.
Okay.
It would take too long.
Okay. I guess if anyone has any
Yeah.
specific ones that they
The
help with.
What about Jonathan? What about you? Which one like you have trouble with?
The beta one's a little,
Yeah.
can get a little tricky.
Okay. And let's focus on the hard one.
Okay, so the thing I like about Excel is that once you find a way to do one of them, you can simply copy and paste and then find the rest of them.
That's right.
So for number 6, an investor currently.
And people has to set up the questions that
Yeah.
you do it.
Yeah, so all you do is just copy and paste it. So An investor currently holds the following portfolio, and we want to know the beta of the portfolio. So we want to know how your portfolio is going to react to the market with all the stocks that we have invested. So let's say some guy gives us $160,000 to invest, and being the savvy students we are, we invest them into 3 different stocks. So first thing we want to know is we want to find our weighted invested, and to do that, you're simply going to divide each stock by the total, because you want to know how much percent of that stock is invested in your portfolio, and it should come out to about a 100. So simply just divide this one by this, and then if you're using Excel, all you got to do is take that little black crosshair and then drag it down, and it'll do the rest for you automatically. So if you want me to click on it so you can that's pretty much. And then once you find your weighted amount invested, you next need to find your weighted beta, because similarly, you have to find out what percent of your portfolio is going to be affected by the beta, because it's not going to be 0.13 because you only invested 10%. So to do that, you're just going to multiply your beta times your weighted invested. And then at the end, you just add them up, and I did sum of all these values, and it gives you 1.99.
So you have to calculate weight, the percentage of each stock in the portfolio first. So 160,000 is a big pie, so you need to figure out what is the percentage of each stock in this big pie. It has to add up to 100%.
So
you can also, do you use some product here?
not for the next one I did, not for this one.
Here you don't have to calculate the weighted beta. You
No,
just use
like for
some
this one I did
product.
that. For this one, say for example, you do equals sum product,
Yeah.
and then you take these.
No, not. It has to be percentage. If you use some product, it has to be the percentage of the weight. It has to be weight.
Sum, and then some of this product, and then take this as the
Okay,
array.
you're right.
And then it's a faster way to do it like
you're
that.
right. So okay.
For that one, I couldn't figure out how to do it for that one, but for this one, I did.
It's the same.
Same way?
Yeah.
Okay.
You can-
Yeah, I guess that makes sense. I guess let me try.
So what you did, you consider the percentage, but divided by the weight. That's clever. I've never done that way.
And then just by your beta.
By the data, yeah.
Oh yeah, I guess you can do it that way too. It's a faster way of doing it.
Can you just slow down a little bit?
Yeah, sorry.
Yeah, give us time just to digest.
So basically with this and this, you're basically eliminating these steps right here. So this is basically finding your percentages without having to do it the long way. So.
Is there a calculator for this as well?
Some product, the weight, no, you have to calculate. You can do Tristan's way, calculate the weight first, like 10%, 30%, 60%, and then it's easy to see it. Just beta times the weight for the stock A plus beta of the stock B times its weight plus C times its weight, and add them up.
Because you're trying to find like the percent of the beta of your portfolio. Because had you invested all your money into stock C, your beta would be 2.2. So since you didn't do that, you have 3 different ones. You need to find the percent of that beta of your portfolio. Does that make sense?
What's the formula? The formula for some product formula?
Yeah.
Some product, you can do easier. This is hard to see. You can just use some product of column C and column D, and that's easier to see.
Okay.
Yeah, this is easier. Some product, array 1 is beta, array 2 is the weight. No, the previous one. The previous one, yeah.
Oh yeah,
these
sorry.
two, right? Yeah.
Alright, so it's 3 different ways you can do it.
Can you
I guess.
show us the syntax of that one?
Yeah.
Some product, array 1 would be your beta, array 2 would be your percentage of the stock in the portfolio.
So this is different from the first one you did?
Yeah, the first one I did is the long way, and I would almost, I guess on an exam, I would do it the long way, because that way you
Yeah.
know if you did something wrong. Because this way you're not going to know or not, but maybe you didn't do your weighted amount invested and you don't get a 100%, you know, so like, okay, well I did something wrong here. That way it gives them more of a, I guess, step by step, versus this and you just do it, maybe you punched in like a wrong cell and you end up getting the wrong answer. So you can, I would just do it more as like a check, I guess, in a sense, just to double check if you did it right or not. So I guess there's 3 different ways you can do it. Long way, divide it by the sum, the amount invested, or just find these 2 and then use sum product. So there's 3 different ways you can do that. So
What about you guys? Jessica, do you have any?
I don't think so. I actually, I found chapter 6 a lot, I could comprehend it a lot easier.
yeah, I think it's easier
First
than the
one.
previous chapter. I think.
The time of money?
Yeah, at that time it was just tricky to find what it's asking you for. Not so much the calculations, just kind of what it's asking you for.
Yeah.
This one's a little bit more streamlined, so it's a little bit easier to find.
In the exam, I had 20-some questions about time value of money, but it's all multiple choice questions.
Oh, okay.
You might feel much better now. It's take home.
Yeah.
How many total questions do you have?
I think it's 30 multiple choice questions, and I had one big question asking you to prepare the cash flow statement. Because that's the hardest one.
And you said 24 of them was time value of money. So.
Yeah. Because we have only 3 chapters. Time value of money, and risk and return, and also the company.
So,
Any
I
other
think
questions?
10's a little bit can get a look because you have to find both your expected rate of return and your weighted beta. 'Cause
Yeah,
you need,
let's try 10, and after 10, let's try one more.
Okay. So for 10, it's basically a very similar one as before. So if you followed it in Excel, all you have to simply do is copy it and paste it down here. But once again, you're trying to find your weighted beta. So you don't have any amount invested, but it does tell you your weighted invested. So simply all you're going to do is times your beta by your weighted invested, and that's going to give you your weighted beta. And then, yeah, add them up, and then that gives you that.
Well,
So-
you don't have to calculate the weighted beta. You can just use again
Yeah.
product of array 1 of beta, array 2 of the weight.
You can do that too.
Because it will be confusing because weighted beta there's no such a term defined as weighted beta.
Yeah, I know what it
Yeah,
means. It's like
yeah.
what percent of the beta is in that portfolio that you
I know what
actually.
you mean here. It's just that you say,
Yeah, maybe I don't know how to
This is a weighted beta, and
Yeah.
I will be
Confused.
confused.
Yeah.
At
I know what it means,
is-
but I don't know how to
Yeah, I
explain it in a way
I know.
that.
It's just a step needed to calculate the weighted beta.
Okay, so maybe I don't know what to call
Well, I
it.
don't know.
So,
We can just say
Portfolio beta?
times- We can say beta times the weight.
okay. Times.
So if you say so, and I know what you're doing here.
So, kind of similar to how you're trying to find, how much percentage you have invested. You're trying to find how much your beta is going to affect with the amount that you have invested, basically. So, so next we have to
You're
find.
not delivering the mails. You deliver the mails now? Oh.
No, I was saying here when I walked in earlier. It used to-
There used to be another guy, he took my parcel for it, and I forgot his name, but he's delivering mails in campus.
Okay. So for the next part of the problem, you need to find the expected rate of return. And to do that, risk-free rate plus your beta times the market risk premium. So in order to find this one, you have to find your beta first, which we did. So simply all you do is just fill that one in the cell. So your risk-free rate is 3%. Your pre-risk, okay, so
Can you also explain to us one questions about the holding period return? Remember we discussed about
Yeah.
the holding period return?
Mhm.
It's confusing.
I think there's one below here is a holding
Yeah.
period return one. So, and then since remember your market risk premium is your risk-free rate minus your market return, you're going to subtract 10% from 3%, and that's going to give you your market risk premium. And then you simply add these two, multiply by this, and that will give you your expected rate of return. So, make sense? Make sense? So number 11, computing holding period return for Jasmine and Solomon during periods 1 through 3. All right, bought in period 1, sold in period 3. And remember, holding period return is the change in price plus the dividends divided by the purchasing price. So we have the 2 periods here, 3 periods, I'm sorry, between the 2 of them. So purchasing price, remember period 1, and your sell price, period 3. So change in price is obviously subtract these 2. And you're going to add your change in price plus your dividends, which you don't have any, and you're going to divide by your purchasing price. So that's, and basically you would just copy all this, put it over here, and then just change the values to Solomon. So
you're not using the period 2 stock price. Why?
because they purchased in period 1 and sold in 3.
Yeah, that's right. So you only look at purchasing price earlier at the beginning, and also the selling price in the end, and also the dividend you receive in between. And but the price will go up and down in this period, but since there's no actions, you didn't sell the stock, so it has nothing to do with you. You can only get the selling price in the end, but in between the price has gone up to a very high number, but you didn't sell the stock, so the appreciation is not. It's not the capital gain you can get from this, because this is not your gain. You didn't sell the stock. So only the beginning and the last, the first price and the last price, and in between, and you don't need the information. It's irrelevant.
Because you just want to know like what your return would be if you hold, since you sold at the final, the second part's irrelevant, so. And I think that's pretty much, all the rest are basically the same thing, pretty much. Find, let's see, beta, find your beta again. So
now you're investing in stocks, you should look at the beta first. You want high returns, you pick a high beta like Tristan's. That stock is 6.5, the beta is really high. And but if you just want some returns, you don't want so much risk, you find low beta. It could be under 1, so it's pretty safe. But if you want some higher returns, you should try some stocks with high beta. That's a rule.
Yeah, and like I said, the middle ground is 1. Anything above 1 is more risky. Anything below 1 is less risky.
Like Apple is about 1.1, and Amazon is about 1.3, and Walmart is like under 0.5.
Yeah. And then the one we saw was like 6.5 beta. So if anything happens,
the highest I've ever seen.
If anything happens in the market that would cause it to go down, your whatever you have invested is going to take a hit.
The beta is high because it's very risky. It's very risky, and the return should be higher. The return is high usually means the stock price is very low. So his stock, the price should be very low.
Yeah, it is. It's like $1.
Any other questions for this homework? Okay, exam will be coming. All right,
That's
thank you,
it.
Tristan.
Like, can you do that report real quick? I'm sorry.
Yeah. It's very similar to the one we did before the holding price period. So prices for the Electric Circuit Corporation for the fourth quarter are given below. So we know at January 1st it was 130, and then we know the stock sold on, I guess I don't have the value there, but it's okay, so here it is over here. Okay. This one is a little bit confusing because the price of the stock here, period January 1st. I don't know why that one's 125 there. I think it should be 130.
The purchasing price should be 130, right?
Yeah, I think.
Yeah, well, that's the end of January. That's the end.
Oh, yeah, okay, never mind then. So since it was purchased
January the 1st.
then that's going to be your $130. and then it's sold on the last day of March, which is right here, which is going to be your
So
132.
you just use 130 as purchasing price, 132.75 as the selling price. But there's dividend paid, right?
I didn't see any. Let me go
No
look.
dividend. Dividend is 0.
I can look again.
So yeah, there's no dividend. So you just use 132.75 divided by 130 and subtract 1. We'll get the difference first and divide it by 130.
Which one's-
No dividend.
There's no, okay, I wasn't sure if there was or wasn't.
Yeah, Tristan, what's your way? Tristan's way is calculating, first figure out the difference, get the difference.
Yeah,
And
change
then
it.
use the difference divided by 130.
Yeah, so, yeah, change in price, I find this first, and then I do
This is
the,
the best way. You figure out the changes in price, use the changes in price divided by the purchasing price.
and then the equation up there. So.
Tristan's going to continue give us lectures on the accounting chapters, right?
I mean, if you want.
Yeah, because only 3 questions for this chapter. In the exam, I'll give you a balance sheet information of a company in 2 years in a row, and I'll ask you to prepare the cash flow statement. Yeah. So what I want you to do, this is the homework.
Mm-hmm.
Okay. Anyhow, what I want you to do is not the homework. Yeah. Like in the class website, I asked you to do 3 exercises. One is to prepare income statement based on Home Depot's information. Also prepare the balance sheet based on the information given. And also the last thing I'll ask you to do to prepare the cash flow statement. Yeah. Since I'm pretty sure Tristan hasn't done that yet, but we can do that together.
No, I did it already.
Not this one. Go to gufinance.com. Go to the website. You can close these, the old ones.
Let's see.
Go down,
More?
scroll down. What?
Did I go too far?
No, this is wrong. Straight. No, close. You can close this one.
Oh, okay. Sorry, that's 5 of them.
That's another one. Yeah.
Chapter.
You have to refresh. Yeah. Okay. Yeah. Okay. So information. See, there's balance sheet and income statement information. I'm asking you to prepare the balance sheet and income statement based on the information given. Since you all had the class in accounting, so you know what's balance sheet, you know what's income statement, right?
Yeah.
So I don't want to repeat it. So let's do that. Tristan, you want to be the person working with us?
Sure.
Yeah. See, now the easy one to do is to prepare the income statement. So
Let me.
you can close everything.
Okay. Close all of this.
So the income statement tells the
Should I save this or?
no.
Okay. So.
Income statement tells how much money the company has made. It starts from how much sales. Start from the sales, subtract all the costs, and then it tells what is the profit of the company, right? So you don't have to do that.
No?
No. Okay, so there is a calculator. You can use the calculator. Yeah, this is income statement
Oh, yeah,
calculator.
that makes it more convenient.
So you see, so each company, no matter what the size is, and then they all start from the sales, take out the cost of goods sold, depreciation, and administration of other operation costs. So that's EBIT, EBIT, operating profit, and then you subtract interest, subtract tax, that will be the net income, and you subtract the dividend, that will be the return earning, that's the end income statement. You just need to fill it out.
Okay,
So let's give it a try. You all have the information. Now let's do this together.
So, you know that sales is 7,000.
That's right.
And cost of goods sold.
Always start from the sales. Subtract cost of goods sold.
693. Depreciation 16.
Depreciation in that year.
16. Admin costs right here. 15.
If it's nothing, just put 0 there.
Yeah, it's in there. Other operation costs, I don't think there was any other operation costs now. Hold on, let's see. Depreciation, oh no, we did depreciation.
Yeah.
Interest expense, 530. Taxable income, so 36.7 times 5. Does it do it automatically for you, or do I need to go and find it?
It will, the blue part will be automatically calculated. The tax, is that given? If it's not given, so you have to calculate it.
That's fine, okay.
Yeah. How to calculate tax?
Multiply
Yeah,
the
see, you have taxable income. Use EBT multiplied by the tax rate. That will be the tax. If it's a given, you just put the dollar amount there.
What is it? 36.7 and then 5,000. Trying to go back and forth here. 7% times 573. No, that's not right. 5253. That's what I got. Right, is that?
Yeah.
Actually, let me just round it. And dividends, 1,569.
Yeah, so is that the same as you guys have? So you see, use sales, subtract cost of goods sold, subtract depreciation, subtract. If you do this, and you get EBIT, that's operating income, EBIT. EBIT is very important. It tells more than net income. And net income is after you subtract the interest and tax from EBIT, that's net income. And then EBT is taxable income. And you use this number multiplied by the tax rate, that will be your tax liability. Tristan is doing that using taxable income 5253 multiplied by the tax rate, 36.7%.
And what do you multiply it by?
By your taxable income. Because that's going to be the income that you can tax, so you're just going to multiply that by whatever the percent of taxes, which is here, tax rate 36.70%.
If you want to use Excel template, you can click on the link, so it will give you the Excel. This is the website version. No, that one on the right, in the calculator.
Yep.
So in the calculator.
Oh, sorry.
Yeah. On the
Oh yeah, that's where I found it. Because that's what I used.
Yeah, so
So if you
it's
look,
a template. It also built in for
yeah.
for the